Okay, so in this lesson, we're going to briefly recap on the lot sizes that you just learned about in the previous lesson. We're going to also dive into what is leverage and what is margin. Now, this is very, very important because you want to make sure that you are protecting your capital, that you're not over leveraging your account, and that you are utilizing proper risk management when it comes to your trades. So let's hop right in. So right here, we talked about previously in the lesson before about a standard lot, a mini lot, and a micro lot. So when you are entering your trades on MetaTrader 4, this is what it's going to look like. So you'll see here, I have entered a 0.0, which that equates to a mini lot. So that means that I am telling my broker that I am willing to risk 10 cents per tick, which is $1 per pip. So just keep that in mind, that it is very important that you understand how the pips work, because you can definitely blow your account if you are not putting in the right lot sizes. And this was something that kind of, I struggled with in the beginning until I understood that 10 pipettes or 10 ticks made up one pip. And so when you are looking at this number, understand that this is the pipette. So 10 of these equals the actual pip. So if I'm putting in a 1.00 right here, I'm actually risking $10 per pip. So I just wanted to reiterate that and make sure that you are understanding how the actual lot sizes work. So think of it kind of like when you go to Sam's Club. When you go to Sam's Club, you have to buy in bulk. They have their things packaged up in what you can think of as lots. So you may go there and you can't just buy one loaf of bread. You have to buy a lot of bread, which is 2 loaves of bread for whatever that price is. So when you think of that, you can it kind of makes sense more if you think of it that way. You can't purchase, just one. You have to purchase it in a lot. So I hope that made sense. So leverage, let's get into leverage, because this is where stuff starts to get real. So leverage is a double-edged sword. It can work for you, but it can also work against you if you are not careful or if you're not educated on how leverage works. And so leverage is basically borrowed capital that your broker is allowing you to use to be able to trade based on the amount of your initial investment. So when you are setting up your demo or your live account, it's going to ask you to select the leverage. When you are selecting the leverage for your demo account, I want you to select the leverage that you would also be trading on your live account. And some brokers, if they are unregulated, will allow you to select some high leverage. I do not recommend that you select anything over a 1 to 100 leverage. If you are in the United States and you are using a regulated broker, they won't allow you to select anything over a 1 to 50. So brokers in the United States are much more regulated and they offer less leverage, which is actually better for new traders that don't know how to properly manage their risk. It keeps you from losing a lot of money. So lowering your risk is going to be critical in order for you to be able to sustain your account and grow it and compound it over a long period of time. So it is recommended that you risk no more than 1% of your total account size per trade. And like I said, the US regulated brokers typically only offer a 1 to 50 leverage, which means that for every dollar that is deposited in your account by you, you can place a trade for up to $50. So if you have, $100 in your account, for every $100, you can trade $50. I'm sorry, for every $1, you can trade $50. So it just depends on how much you are putting in your account. So $1 actually equals $50 in your account. So the most popular leverage that most Forex traders use that are not using a regulated broker is 1 to 100. And like I said, I advise you to not go over that, because you can, especially if it's a live account, you can lose a lot of money that way. So you don't want to do that. You can blow your accounts very quickly if you're over leveraging and not using proper risk management. So anything over a 1 to 100 leverage is extremely risky, and I don't recommend it. So let's hop into what that actually means when you are in your MetaTrader 4 account. So I have a screenshot here of an account where you can see the balance, the equity, the margin, free margin, and the margin percentages. And you've probably seen this if you've traded before, or if you started to trade on demo and you probably weren't sure what all of this actually meant. So I'm just going to briefly explain that so that you can get a better understanding of that. So your balance is basically how much is in your account currently, but it does not include your open trades. Your equity, however, is the total amount in your account, including open positions. So if you are winning or losing on a trade, that is going to be reflected in your equity balance. Now, margin is the total amount of leverage your open positions are utilizing. Now, sometimes you'll see where the margin is negative. That means that you are close to being margin called. And what margin call is when your broker actually closes out trades on your behalf to keep you from blowing your account, or it's letting you know that you're close to blowing your account. So whenever you go into the negative in your account, you want to start liquidating positions and closing out some of those trades, because typically when your broker does a margin call, they're going to close out the largest trades first. And so you don't want to over leverage. This will not happen if you are practicing proper risk management, if you are not risking more than 1% per trade, and if you have your proper stop loss set prior to you getting in a trade. Your free margin is the equity minus the margin. Your margin level is the percentage value that's based on the amount of equity versus the used margin. And so if you are, like I said, practicing proper risk management, then a lot of these things won't be a big deal. The main thing that you want to focus on is your equity and your margin, because those two are going to determine how secure your capital is in your account. So again, you want to make sure that you are not over leveraging. Stick to 1% per trade, so that you're not risking your entire account on 1 or 2 trades. So let's recap. By now, you should understand what lot sizes are. You should understand what leverage is and how to properly use it. And you should also understand what margin is. And so what I want you to do for your homework is I want you to place 3 trades in your demo account. I want you to place one with a lot size of 0.01, which is a micro lot. I want you to place one with a 0.10 lot size, which is a mini lot. And I want you to place a trade with a 1.00 lot size, which is a standard lot, so that you can see the difference in the leverage and the profit and loss when it comes to the different lot sizes, so that you can get familiar with those and see the significant difference in those lot sizes. Make sure that you are doing this on your demo account, not a live account, so that if those trades that you put in do not go in the right direction, it won't matter because it will be on your demo account. So moving right along, we will be hopping in to the next lesson. We'll dive deeper into lots and leverage and pips and margins. I just want to introduce these concepts so that as I begin to get into the more intermediate trainings, the technical analysis, when I am, discussing these things, you will be well aware of what they are and what they mean and how they affect you in your trading. So do the homework. You can post your screenshots below if you want to do that, just to show that you are completing the homework, that you are completing the lessons. And I'll see you on the next module.